Bravo, America. You're setting all-time records on destroying your personal finances.
I am very excited about this show because you came to us and you were like, guys, I found these stats. I found this chart. We have to talk about this because this is some kind of shocking data about where things are trending in regards to a big money mistake.
I was raised, first of all, Bo's out today. We have special guest Reby sitting at the big desk today because Bo had a cough. We'll just say he's under the weather. But
He's needed a day off. The man's allowed.
But it is one of those things where I think about just what are we doing? And I grew up in a household where my father was a great disciplinarian, but he also led through disappointment. And the fact that I could tell when I disappointed my father, I want to lead that way and let you know I'm disappointed in America because we always had a problem with discipline and consumption versus creating. And you see this in all the stats, but we've set an all new standard. And let's just go ahead. We don't have to beat around the bush. We can just show you the data and let me kind of curate the parts that really bother me. First of all, let me set the table context. We have a debt and discipline problem, Reby. It's one of those things where credit cards, we tell you, don't have credit card debt. You can use credit cards, but credit card debt is something you just should avoid. But you can see when you look at the credit card debt, we've had, $650 billion worth of credit card debt. We've had $750.
Which is still a lot. Can I just say? It's still a lot for a country to accrue this much debt.
But we would never, pre-pandemic, we had never hit $900 billion. And you can see we actually had a period when the pandemic happened and we had all the government stimulus come in. A lot of people, you can tell that money came in, they used it to pay off debt. That's a positive. That's actually a positive behavior. You can see credit card debt just dropped off a cliff. It went from, it looks like right under $900 billion down to a little over $750 billion. Actually, a little lower than $750 billion. But then this is where the music and the happy times have kind of ended because look at the savings rate. Now, Daniel and I know because as we've worked on some content together, we always talk about that Americans typically only save about a third of what they should because the savings rate is somewhere between 7 to 8%. You can see pre-pandemic that was, had a little variation up, a little variation down. But then the pandemic happened and you see because that first stimulus check of $1,200 popped out there under President Trump, you had this huge spike. That's where companies were getting stimulus from the government, individuals were getting stimulus. And then you see the credit card debt comes down, savings rate spike way up, well above 30%, because there's no way for people, but also it was a distortion.
I know.
I love the optimist.
I'm trying to be positive, Brian, because it's about to get negative again.
It's a distortion because people just couldn't do anything. We were all locked down in our houses. We couldn't spend, other than Amazon and groceries. That was pretty much all you could spend money on. But you could see that the savings rate did start to come down. And I was hoping we'd get to retain it, because there was an intersection point with where the credit card debt was. And we even saw a spike again when President Trump, right on his way out, I think he gave a stimulus of $600. And then President Biden, once he got inaugurated, he was like, hold my beer, and he actually decided to kick it up a notch and take it, he added 12, I think it was 1,400 actually on that one. But here's what's crazy. That's where we got so used to all this money coming in. We got so used to and feeling comfortable, I feel like, with credit card debt being down, that now here's the rest of the story. And I tried to be very descriptive because I know a lot of you are listening to this while you're on your commute or you're exercising. You don't get the visual stimulus. You don't get to actually see the charts that we create. But if you see the chart, you know the rest of the story is because it's almost like this thing was a fork in the road, with credit card debt now ballooning to $939 billion, all-time highs. Savings rates have meanwhile the bottom's fallen out to where now instead of being around 7-8% of our income, it's at 3.4%.
Yeah, and if you're listening, this chart goes from 2016 to present day. This is the lowest the savings rate has ever been.
Yeah.
And I will say, several years back, early to mid-20s, I discovered the power of compounding interest. A lot of it's thanks to you, Brian, and how powerful that can be with investing. But what gets me is I also saw why people were so cautionary about credit card debt, because now the compounding interest is working against you. And it's not just working against you. We have another slide about why we say credit card debt is a no-go. Guys, it's because the average APR for a credit card is over 20%. That's a lot.
Y'all know, because we talked about this in show prep, is that when we do our money multiplier, I'd encourage you to go to moneyguy.com/resources, see what every dollar in your army of dollar bills has the opportunity to become. And one of the assumptions we make for a 20-year-old is that if you can invest $1 when you're age 20, assuming a 10% annual rate of return. I know that's aggressive, but you're 20 years old, you can be aggressive. And if you look at the historic return of the S&P 500, it's around 10%. If you could do that all the way through age 65, that 45 years, that dollar has the potential to become $88. That's what I always say. You'll look at how you consume your resources, how you spend your money. If you can look at everything with fresh eyes and know every dollar has the potential to become 88. But the trolls, they come out, they wake up, it's like they scratch their eyes and go, whoa, did he say 10%? I heard that guy, he said 10%. That's an unrealistic rate of return. But yet, the same people who will tell me 10% is unrealistic won't bat an eye that the interest rate on credit cards is twice. It's 20.28%. Also, another high. I mean, we haven't seen credit card interest rates this high in my experience. I don't know if this is an all-time high, but this is the highest I can remember on this. How do you ever get yourself into a financial independent or financial freedom situation if you're carrying around something that is charging you twice what you hope in a good year to make on your investments?
Yeah. And so let me recap too. Credit card use, okay. There can be a lot of benefits to using a credit card if you're able to use them the right way. But credit card debt is absolutely no way. And this is why. It's because we don't want you to fall prey to these almost predatory rates of like compounding interest just working against you. And that's the best way to get your financial life into a ditch. And we want to keep you from that. So if you're if you're listening to this, first of all, and you're like, oh shoot, this is me. Like I have some credit card debt. I want you to know, clearly you're not alone, but I also want you to know, like, get motivated. Let this motivate you to like knock that out, because that's going to set you up for so much more success and so much more peace of mind and eventual financial freedom. And that's why we wanted to even share this chart in the first place, because we want to motivate you and let you know that you can move past that. And if you are using credit card debts and that's not you, keep going. Don't be part of the statistic that's climbing these amounts of credit card debt up. And if you're interested in learning more about how to handle debt, what you should do with your next dollar, very specific strategies for even paying down debt, like what qualifies as high interest debt. Should I do an emergency fund first, or should I pay off my credit card first? That's why Brian and Bo created the Financial Order of Operations. We do have a free download that shows you the steps in order. There's 9 steps. It'll help you know exactly what to do next. Go to moneyguy.com/resources for the free download. But if you want the nuances, if you want to know how exactly do I go about paying off this debt, how do I maximize, and also get access to a community of people who are asking some of these same questions, go to learn.moneyguy.com and check out our Financial Order of Operations course. That's why we made a course, because there's just so much to dive deep in. And also, if you don't want to wait till you've watched all of the Money Guy episodes, which they're awesome, they're always there for you.
Well,
if you want it to be consolidated and you want to get it like today, that's why we made the course, because it's just a lot more digestible if you need to like make changes now.
For sure. I mean, this is our mission, is that I want to turn, it makes me sad when I see people who have all the components of creating wealth, but they actually fall into this consumption trap that so many Americans struggle with. And that's why we did a show, because I think it's no coincidence. I love when things line up like they do, Reeves, is the fact that we did a show on how many Americans can come up with $1,000.
Right.
And I would encourage you to go check that out. And we did that in the last 2 or 3 weeks. And part of what we talked about on that is that everyone, because the sad stat is that 57% of Americans can come up with $1,000. I think I want to challenge everyone could have $1,000 if you just start thinking a little differently. We laid out some truly practical ways you can do this for yourself with looking at ungrateful service providers, with looking where your money's leaking out the door, whether it's those small decisions like the coffees, the juice bar, or pulling over and getting the pack of gummy bears every time you're driving by, or an energy drink, to big decisions like the cars and the things like your housing. Go check it out if you want to do that. And then, of course, Reby is spot on. The financial order of operations, if you've ever wondered, what do I do with my next dollar? What's the instruction manual for how to handle money? We know that there's actually a better way to do this, and that's what's actually led us to create content. This was something, because we've been doing this since 2006, that I think everything and anything is out there for you to discover. But if you want to have a curated fast forward, first go get the free deliverable with moneyguy.com/resources. But of course, the course is going to go deep into the things and really accelerate your success. And now, Reeves, I'm super excited to kind of jump into the next phase of what we like to do on these Tuesday live streams.
No, we love answering your questions. So if you're watching this live, make sure you get your question in the chat. We've got FTE Daniel and our team working to get those to us so we can answer your questions right now. So you ready to dive in, Brian?
I'm ready. Let's hit it. I got my fresh page here. You can see the tablet is blank, ready to start writing some notes. Let's hit it.
This is great. Okay. First question is from XZenith42, and I really like this question. He said, Brian says he felt like he had money around age 41 or 42, around there. Can you describe what changed? The number, the income, your money guy multiplier, like what all went into that feeling? And then he also said, what changes did you make to go from frugal saver Brian to spender Brian, or maybe more financially free Brian?
Yeah, I think it's good to give some context here, because that's spot on, Zenith, and the fact that I say this to kind of give the experience share that I think it's okay in your 20s, you're going to feel broke. But the good news about being in your 20s, because you have time, but you don't have a lot of resources typically, is that you can also put up with anything. It's so funny is that pre-show, Katie was showing me kind of, vacation anniversary trips, and I was looking at this thing, and it was very cute, and I was like, this is the perfect vacation for Katie, because they're early in their marriage, they don't have kids yet, so they can go do these type of things. And that's the beauty of your 20s, is that you're discovering new things. Daniel just got back from New Mexico, so you're seeing things for the first time, you're experiencing things for the first time, so your eyes are open. So it doesn't take a lot to create big excitement and big changes. That's okay, because you're in your 20s, you're adaptable, but you don't have a lot of money. And then you fast forward and you get into your 30s, and that's when you start having a growing family. You have the first house come on board, because we know that average age is around 33, 34. And you're just going to feel like the whole world is working against you. And the fact that there's just so many things pulling at your pocketbook, at your wallet, that you're squeezed.
The
and
messy middle, if you will.
That's exactly why we call it the
You're
messy
speaking
middle.
my language
Yeah,
there.
because especially with the crying babies, the job needs more from you. You just feel like you are just being pulled in all kind of different places. That I feel like a lot of people will get fatigued. They will they'll want to give up. They'll see their friends and their peers that seem like they've got it all figured out, but they're doing it all at $200 or $300 at a time with monthly payments and using debt as the bridge to nowhere. So it was true that by the time I reached 40, in my early 40s, I felt like the rays of sunshine broke through. And I think a lot of this is also because I was hard on myself in my 20s and 30s, because I remember I have shared that I talked to my wife in my 20s and I said, look, we're going to prioritize saving and investing a chunk of our income now while we don't have a lot of commitments. And then we even prioritize this in our 30s in the messy middle, because we knew it was going to be tough. But if we did this, this is the promise I made to her, is if we do this, by the time we reach our 40s, we're going to be able to take our foot off the accelerator. And I had some personal goals too. I wanted to make $100,000 by the time I was 30 of income, and then I wanted to have 7 figures of liquid net worth by the time I was 40. Both of those goals I actually missed by exactly 1 year, because I started my company when I was late. I think I was early 27, 28, somewhere in that range. I'm getting so old that years run together. But it was went out on my own in 2002, And by the time I was 31, I think is when I crossed six figures, and then I didn't cross seven figures liquid until I was 41. Because now I had net worth over the seven figures, but liquid is what I was thinking about when I talk about cash, when I talk about your investments, your after-tax investments, and other things like that. And it was one of those things where I'd reached that critical mass, or what I like to call the bowling point of your wealth building. Is it happened in my 40s, and I think it's important to share that, because a lot of people in society are telling you, look your best in your 20s and 30s. Don't worry about building up those assets to invest and so forth. And that's all the bowling point of the critical mass of bowling does not occur for water until 100 degrees Celsius or 212 degrees Fahrenheit. But up until you reach that temperature, it looks like nothing's happening. So I think a lot of people in their 20s and 30s can give up too early. And I just want to give you, Zenith, the inspiration to say, stick with it, stay the point, reach that bowling point with your assets so you actually get to see the fruit of all your hard work. And there's a reason that when like Ramsey Solutions did their biggest study on millionaires, it took exactly 27 years for the typical millionaire to cross into. And that's in your 40s. I mean, that's where the millionaires actually start popping up all over the place. And yes, there's some exceptions to the rules in their 20s and 30s. We work with a number of you. But for most people, it's going to happen in your 40s. Stick with it. It gets really good. Then you'll start spending more on vacations than you made in your first year out of college on your income. That's the payoff point. Life can be good. Just stay the course. And then don't think I'm telling you to be a miser. You can bedazzle your basic life while you're younger as well and still do vacations and trips. Just don't be trying to make it Instagram perfect like a lot of people in your peer group are going to be doing.
So is a big part of it, in my mind, just thinking through it, like seeing that your money invested is growing to a significant enough point that like you feel okay, like it's making enough money.
Yeah, well, there's two things that are crossing. You're starting to reach some of your peak earning years. That the peak earning years happen in your late 40s. Yeah. So even in your early 40s, you're seeing the payoff in your career. So your income's reached a point, plus your assets have reached a point. And if you've done automated wealth building where you're automatically on a monthly basis, this month goes into retirement savings, this month goes into the kids' college, this month goes to pay off the mortgage. That if everything's automated, it really is like you've reached that point to where everything lines up. Whereas it felt like in the 20s and 30s, it was all a struggle. Mm-hmm. I'm having to figure out every dollar and be very disciplined with it to make sure that I'm prioritizing these assets. Whereas in the 40s, your income and everything lines up in a good way. The kids get a little bit older now that, look, they're not at college yet. That's a whole nother expense level that kicks in. But you are at this point where, going on family vacation seems a heck of a lot easier versus when they're babies.
That's true. No, good answer. Thanks so much for that question, XZenith42. We appreciate you. Brian, do you want to talk about inflation? Are you cool with that?
Yeah, we can talk about inflation.
All right, we're going to talk about inflation. So Mo has a question about this. He says, inflation came out today a little bit hotter than expected, which means the Fed might have to raise rates more than markets thought. How should financial mutants think about this? And are there any action items?
Yeah, I saw the data come out this morning. Here's the thing, I think, and I'll be curious to see how the Federal Reserve kind of positions themselves after this, because look, I think that don't get caught up in the news cycle, because look, every talking head on all the financial channels will be jibber jabbering about this. But the reality is everything is a laggard, has a lag to it. So it doesn't mean just because inflation's up 0.5% that we are back to wide open again, because it sure doesn't feel that way. I mean, I've been dealing with a number of phone calls with clients who have been reduction in force, especially if you're in the tech field. All the extroverts of a bad economy are kind of hanging out together right now. You don't see real estate running wide open anymore. It seems like if you need a used car, you can get a used car again. There's a lot of things out there, and I'm sure that the Federal Reserve is going to be taking that into account as well. So I don't know that this necessarily blows up everything, because we had been getting some positive indicators that inflation was under check, and hopefully, and even the Federal Reserve has acknowledged it, because we went from those huge 75 basis points bumps to now we're only getting 0.25% increase. So that they're even indicating, hey, it looks like what we've been doing has been working. But here's the big thing. That's noise. Now, yes, it has an impact on your cash reserves, and I would encourage you, make sure you're looking at online savings accounts or even your online brokerage accounts. You can easily get 3.5 to 4.5% on your cash reserves. That is impacted by inflation. But your long-term money, the money that you don't need to be touching or even thinking about for 7 years and beyond, that doesn't matter. I mean, and that's why I want you to stay the course. Don't try to feel like you have to change a lot of your allocation and other things, especially if you're 20 years, 30 years, 40 years from retirement. This is just going to be another moment in time that I don't want you to lose focus on the why and what you're trying to build assets for. But short-term stuff, like I said, I just did a show on credit card rates are at all-time highs right now. Your savings are actually making cash is not trash right now. That stuff is impacted by inflation, but long-term financial decisions, things that are going to go into the financial order of operations, that's going to be minor decisions. Your life changes and needs are more important than indicators like just inflation.
That was good advice. Yeah, thanks for your question, Mo. A very timely question. And I like when you kind of bring us back, Brian. You're like, hey, stay the course. That's why we share the knowledge that we do, so that hopefully you have a good plan and you can feel like you're okay, even when things like that happen. All right. Jason has a question.
Okay.
He says, when dollar cost averaging into the market, quote unquote, always be buying, he says,
always be buying.
How far should you take it? That is, should you make a purchase once a year, once a quarter, once a month, once a week, every day? What do you think? How should he think about this?
Yeah, Jason knows what I'm going to say because he knows I'm a financial mutant. I'm sick about this thing a little bit.
You love to just dial it right in.
It really, now look, it's all going to be determined. The whole part about dollar cost averaging, for those that don't know, we try to figure out, is it better to put it in all at once or do you spread it out? There's two different versions of dollar cost averaging. There's lump sum, meaning you have a big chunk of money come your way, and then there's also the dollar cost average of just your monthly cash flow and your forced savings, the forced scarcity you're putting on yourself to save for the future and invest. Obviously, the lump sum stuff, if it's small and immaterial to your life, actually putting the money into work all at once typically works out 8 out of 10 years or 80% of the time. But if it's material money, you sold some land, you sold a business, you got some big money coming in, then you want to spread that out typically over 10 to 12 months, maybe even less, depending upon how much money it is. I'm trying to make sure I give everybody the overview. But back to my point of this starts off as being consistent. So it doesn't matter if you're like a salesperson and you get a one-time annual bonus every year, you're going to look at that annual bonus, you're going to figure out how much can I allocate to the financial order of operations to fill up the cash reserves, pay down debt, do whatever I need to. But there's going to be a chunk that you'll probably allocate to long term. It's okay if you get that check once a year and then you will put it in once a year. That's still dollar cost averaging because it's a consistent behavior of every year you're putting in that money. It's for the people that are doing this as part of their cash flow also with the monthly, because that's where it starts. Is I want to encourage you to try to, be putting into your employer plan, like your 401k, your Roth IRAs, and those type of things. You'll be putting in once a month, but you will reach a point where especially when you get to step 7 of the financial order of operations, that hyperaccumulation, you'll start loading up that after-tax money as well. And when you start filling up that after-tax bucket, you're going to start realizing you have money going in from your 401k, you have money going in from your Roth, you have money going into your after-tax. And then this is when you get really cute with it, is because I started off once a month, and then I started noticing, hey, I'm always buying either on the 15th or the 30th, it feels like, the middle of the month and the end of the month. I was like, but I really enjoy that feeling I get as a financial mutant is that when the market's down and I'm buying, I feel like I'm getting a little bit extra on those dollars. So I was like, so what would be really cool is instead of buying on the 15th and the 30th, what if I was buying every Friday? And so you can't hit every Friday, but you can say every week. You can basically structure. So it's a sickness. Now, I don't think it will go beyond once a week because I haven't felt the need that I need to be dollar cost averaging every day. But I do have money going in once a week now. And it's kind of fun from a financial mutant. Because look, it's all irrational, but this is the mindset we have that we're maximizing every dollar that comes into our possession. I think it's a fun little, mental exercise to get excited that, because it turns a negative like lemons into lemonade, and the fact that that day that the market's down 1 or 2%, you're like, it's all right, I'm buying the next 2 days.
Yeah.
So I'm going to take advantage of that, even though your lion's share of your assets are out there fully invested. It's just one of those little mental tricks that's kind of makes it fun to be a financial mutant.
Well, I know that I like hearing you talk about that because you are the financial mutant. And so you think about all those things, whereas like I don't naturally think about those things. But I like what you said, that it's about, as long as you have a plan.
Yeah.
You know, and like you said, I think a lot of the time it just aligns with, you know, your pay periods. Like when you're getting paid, is it once a month? Like you're going to put it in. And like that's great. That's a great place to start. So good thoughts.
Yeah. Be consistent and always be buying. That's the thing. I think if you're, I talked about recently that there are a number of our clients that one of my greatest achievements is that I feel like I have nudged them, peer pressured them, and made them wealthy, kind of in a subtle Jedi mind trick way, because all I did was I squeezed them to save an extra $200 or $300 a month. Every time they come see me, I'm like, you know, that's great that you're saving this, but what if we did this? And then I love that I've worked with these people for some of them beyond 15 years. And they're like, man, how did it get so big? And you're like, well, you know, all those times that I squeezed you to save an extra $100 or $200 a month and you set it and forget it and never looked at it again. That's what wealth building, automated, inevitable wealth is, doing that behavior. Get out there and make it happen.
Yeah, that's good stuff. Thanks so much for that question. Jason. Moving on to Jacob's question. He says, how do I choose an online high yield savings account? And I think this is a good question because they're back up. You can actually make some money in a high yield savings account. So he says there are so many bad reviews on how account owners cannot get their money back or various things like that. I am tempted to use a money market mutual fund instead. What do you think about this idea? And then how do you choose a high yield savings account?
This is a great question and very timely. I'm glad Jacob asked it because Bo's not here to defend himself, so I can pick on him. You have to be careful because the easy solution on these because look, first compare your traditional brick and mortar to your online savings accounts, and you're like, this is almost criminal. Why do our traditional banks not give us money for cash? And the reason is because the stats show once you open up a bank account, historically, you keep that account open for 16 years. So the banks know that it's a lot of headache to open an account, that you're not going to switch accounts very quickly. So the brick and mortars underpay you, basically give you pennies on the dollar of what they should. Meanwhile, the online banks gamify the system. And what do I mean by gamifying the system is that you will see, if you go to bankrate.com and look at their list of top online savings accounts, a lot of those top of the list ones, you're not going to recognize the names. But they're going to be the tippity top. But you have to be careful of this reindeer game that they do, is that banks will set up so they can get the top tier, look like, you know, on the top of that bank rate list, because they know a lot of people will go out there to see what is the most paid. But then they'll only keep that teaser rate for a few months. And then slowly they will take the interest rate within that account below market. I'll never forget, because there was a company back in the day, it might still be around, but it was Immigrant Direct. They were kind of one of the leaders in online savings accounts. Don't just run out for them yet. We'll hear the rest of the story. But they started spinning off kind of like satellite companies, still under the Immigrant Direct Bank. But they, like, I think there was like Dollar Savings or something. Bo jumped in on one of these to get the teaser rate. And then I got to watch as he was frustrated that they started dropping the rates and where it was underperforming. By the way, it's not just these banks that you've never heard of. I have just worked on Capital One. I hope you're paying attention, because I don't mind naming you by name. And the fact, because I told the customer service rep, this is ridiculous. And the fact that I had one of y'all know I'm very transparent on who I've worked with. I don't get any referral fees or anything. I just share with what I got going on. Capital One, because these credit card companies have sometimes been some of the better paying online savings banks. They're FDIC insured. So I had Capital One as one of mine. But here's what I don't like. I found out, because I was complaining to somebody that they were only paying, you know, still like 0.85 or maybe a little over 1%. They're like, no, Capital One's paying well over 3%. And I looked, I was like, no. And I went and looked. They had done the same thing I just said, is they had opened up a new product line. And then anybody who was on their old product line, they've started dropping, they didn't raise the rates to keep up with the marketplace, and all the new dollars are going into the new one. So I called the customer service and I said, hey, why is my money not in the default one? Why can't you just convert me to that one? No, we can't, sir. We can't. I mean, I guess you manually could pull that money out and I could open it up, and I was like, why is this not automatic? It's because they're playing reindeer games. So be careful. I would go with companies that seem to be always top tier. If you want to know, now look, I get nothing for this. This is just me sharing just hang around. These are not recommendations. Just do your own due diligence. But it seems like Ally, which is the old GMAC financing arm that rebranded as Ally after the Great Recession, they always seem like they're top of the list. I know another one is like Marcus, which is part of Goldman Sachs. They always seem like they're top of the list. I used to say always look at the credit card companies, the Discovers, the Amexes, the Capital Ones, but be careful based upon what I've seen Capital One doing recently. That's kind of troubling that they're playing these reindeer games. I hope they hear this and be like, maybe we're losing some goodwill from our audience. But here's one final thing, because I don't mean to go on a sidebar too long, but I'm just trying to educate you guys because this is an important topic with cash. Your online banking that is FDIC insured, those are great, but they're probably going to be less than your brokerage accounts, because Jacob had mentioned that he was considering looking at some of the online money markets. I want to give you guys a very quick education. Right now, it is true, the brokerage accounts and their money markets are going to be the higher interest rate. A lot of those are paying close to 4.5% right now. I know that will get dated depending on what happens with interest rates, but realize those are not FDIC insured. They are very, you don't see people break the buck. So they are very safe. I have a lot of money in these money markets too, but you do need to know, if the Fed drops interest rates just like they raise interest rates, the first thing that will be impacted by that is your online money markets. Your brokerage account money markets will drop faster than your head can spin to keep up with what's going on in the market. Your online banks will probably be much more of a slow drop, just like they've been a slow rise as the Fed has raised rates, is because those FDIC online banks, they're going to be more consistent. So make sure you understand the behaviors of both of those two different products. They're both very safe. One's FDIC insured. The other one is, more of, just safe by what they're buying, treasuries and other things within them. Make sure you're paying attention to what the portfolio is designed with. But do understand those online banks, you probably want to have a relationship with both, because I like having an online bank that I can attach to my normal traditional bank, and I just transfer the money back and forth. That's my very safe FDIC money. And then I keep all my opportunity money that's above and beyond emergency reserves and stuff, I keep in the brokerage account to get that much higher yield.
Awesome. Thanks so much for that question, Jacob. Good answer, Brian.
Well, I gave very nerdy answer. I hope
that's what the people want.
Well, we'll see. We'll see how that video does, because a lot of people, I think, sometimes are like, is this guy really that nerdy? Yeah, we're that nerdy with, this is the stuff we pay attention to.
You know how to maximize. I think it's good. All right, let's move on to Dominic's question. He says, I'm about to receive a bonus from work that will wipe out all of my high interest credit card debt.
Oh, congratulations.
Which is awesome. But I have no emergency fund. Which is best to tackle first? It's almost like if only there was a plan. There were like 9 steps that could show him what to do.
Yeah, that's what. Thank you for setting it up, Reeves.
I know, I was being a little cheeky there.
Dominic, here's the thing. Financial order of operations, we've thought through this. You don't have to create your own system. We have a system for you that's going to maximize all these things. Think about it. If you go to moneyguy.com/resources, you can also download this. If you need a deep dive, we actually have a course that goes way deep into accelerating your success. That's at learn.moneyguy.com. But this is the point that Reby was making, is that if you think about this, you've got this credit card debt. That is a disaster, especially with interest rates being over 20% now. We got to get that under control. But you do have these spidey senses that are telling you, hey, I know I need some cash, because I don't want a minor problem to turn into a catastrophic issue. So this is why we came up with step one of the financial order of operations is deductibles covered. This is to keep your financial life out of the ditch. You know, I know there's other systems out there that tell you to have $1,000. Well, $1,000 may or may not, definitely make you be better than 57% of Americans. But if your deductible on like your health insurance is $2,000, 1,000 is not going to get you there, and I would hate for you to be so close to keeping your life out of the financial ditch, but still falling off because of a medical emergency or something where you have to make some desperate decision where you're going to your credit card. You haven't really fixed your problem. So that's why we say step one is actually deductibles covered. Now, yeah, it requires a little more calorie from your brains and the fact that you have to actually go pull all your insurance policies, like your homeowners, your car, your medical. Go see what all your deductibles are on all your different insurances that protect you from catastrophic, take your life into a bad place, and then take the highest number. If that number is 2,500, that's your number. You don't have to add them all up. I think that's a big fallacy that people have.
Yes, that's actually very important.
Yeah, you just take the highest number once you've reached that. So if your highest deductible is 2,500, Dominic, do that, and then everything above and beyond that, you know, obviously we have the employer matches step 2, that's free money, but then step 3 is that high interest debt, which is definitely your credit card debt. Knock it out, take care of it, be good and efficient with how you look at every dollar that comes under your management. That's what the financial order of operations is going to do for you.
Yeah, so hopefully that helps you. Congrats on the bonus. That is a great way to kickstart this process for you. So hopefully you can get those deductibles covered and then knock out that credit card debt. So you don't want that negative compounding interest working against you. So thanks for writing in and thanks for your question, Dominic. Next up, we've got Sam's question. He says, I'm getting a decent amount of passive income, but I'm scared to quit my salary job. What do I need to consider to make this jump?
Well, this is always so interesting. I think downturns, the number of businesses and other things that it creates, it's almost like look, downturns, I always tell you guys, the bad stuff, they're all extroverts, you know, whether it's real estate marketplace, whether it's recession, whether it's the stock market going down, unemployment going up, these things all hang out together. But always the optimist in me likes to say there is a positive thing. The lemonade that comes from the lemons is that we get so many people that start businesses without meaning to start businesses. And it sounds like Sam is kind of somewhere in that journey. But it's one of those things where he's trying to figure out, do I jump or do I keep the comfort of basically still having a wage? Because that's the difference. Do I do this on my own or do I do the wage? As an entrepreneur, you're never going to, it takes a while to get rid of that fear, if it ever goes away. I think this is one of those things I always say, entrepreneurs have a healthy fear that it could go away tomorrow. But that's why a healthy entrepreneur is actually going to take action to make sure you're creating up your own basket of funds on the side to bridge whatever might come your way, because it's uncertainty. That when you're doing things on your own, whether it's passive income, whether it's starting a business, there's always the uncertainty, whereas it feels very safe when you have wages coming in. So how can we bridge that gap? And that's why y'all know when I started my first company, we actually lived, my wife was still working at the time, we actually lived off of just one of our incomes, and then we saved every bit that was coming in from the other's income. And they were fortunately very, very similar to each other at the time. And that allowed me to build up, we were able to build up, I think, around $45,000 worth of cash. That was the cash that bridged us that first 3 years, because we had our living expenses down to practically as low as possible, because that's also a good exercise here as you're considering making a big life change. But go ahead and do that, Sam. Go ahead and figure out if you can cut your living expenses, because that will help the burn rate while you're going through this period. Take a trial period where to see how low you can get your living expenses down to where you're not actually using any of your wages. Because if your passive income is truly covering what your costs are, you should be able to live off that. So now you should be 100% saving whatever your wages are after taxes. See if you can do it. And the cool thing is, if you do this for 3 or 4 months and it worked, then you know, hey, I probably I'm really close to being able to really jump off. And I feel like I have, and just make sure you pay also respect to the cash emergency reserves, like I said, so you have that bridge just in case you have some unsuspected things that come your way. But, and if it doesn't work, you'll be like, oh, it's okay. I still have not left I'm still tethered to my employer, that I can figure out what messed up and do better. And that's why, Reby, I always say, put on your 3D glasses and let's look at the three scenarios, because
right.
you've got the way we always think about this is that there's the dream, of course. That's your, oh my God, I'm gonna be rich. That's the first D. We always want to do that one because that's the one that's the most exciting, is the dreaming, where you think about how rich. And then there's the one where the D is what this is going to be, what is likely going to happen. This is the down to earth plan or version of this. This is what's really going to happen. And then of course there's the do plan. This is the one where, oh my gosh, what have I done? But the good news is, if you do this plan on the front end, Sam, you don't have to be surprised by any of the reactions. You've actually got a plan for every one of the things, and you'll be prepared to do it and live your best life and know that you did it right. I think a lot of people get excited about going out on their own and this passive income, and they don't do the 3D, put on their 3D glasses, and then they're shocked when some sidetrack thing comes their way, some obstacle, some that puts them back, and then they don't have no way to cope with knowing what to do. You'll be prepared. You'll be an all-terrain vehicle and ready to roll.
That's really good, because the first thing that came to mind, which ties in perfectly with your 3D plan, I immediately went to nitty-gritty, like, okay, well, what are you doing about health insurance? Do you have your taxes all worked out? Are you paying quarterly taxes already? Do you know how much money you need for that? Like, is your house paid off? Do you still need a certain amount for rent? Like, there's so many little details. So if you do what Brian just said, and like make sure you're writing it all down, factoring it all in. Like, is there another source of income? Do you have a spouse or a partner? Like, what is your risk tolerance and what is your base level? And then I love your idea of practicing. I think that was a fantastic point.
Measure twice, cut once.
Right. Okay. Well, great. Thank you so much for that question, Sam. Hopefully that helps you out. Next up, we've got Wandaya. I think I'm saying that right. I'm so sorry if I'm not. I always say that, but thanks for your question. Wandia says, if there is a possibility that I'll be laid off from my job, are there steps I should take with my money in preparation? And they say they do have an emergency fund, so that's good. But what else should they be thinking about? I know that there's a lot of layoffs happening right now, like in tech. So this is actually a pretty timely thing to discuss.
Yeah, it's one of those things where I told you guys, just giving you the experience share, 2008, 9, 10, I had no cash because I was so smart in the fact that I had access to cash. I didn't need cash. I had access to cash because I had a home equity line that was over 6 figures. The bank had been so nice. They gave me a checkbook and a debit card on it. So what was the worry? Who needs to worry about having cash? But we all know cash is like the oxygen we breathe. We take it so for granted until we're underwater and then go, oh, crud. So, Wanda, first, congratulations that you actually have the emergency reserves. I would say, before I let you move on from step 4, the financial order of operations, just go re-evaluate. Make sure that in the past, maybe you only had a 3-month emergency reserves because you thought 3 months is all you'd need. But under this economic climate that we're currently in, you might want to recalibrate and say, hey, maybe that was 6 months. So I would just go double up on measuring twice, cut once on, is your emergency reserves really in a good place, like you shared? And because you might, if you feel like your job's in jeopardy, it is one of those things where you probably want to, cash is going to be your friend. So boost up your liquidity as much as possible. It's also a great time. I talk about this challenge that I have for people is to go look at your ungrateful service providers, go, clean out your, do a pantry audit. There's all kind of things in my life. I know whenever I've had the darkest of times, all I have to do is just go visualize what the heck was I doing in 2008 and 9, because I've been at the bottom where it's been so scary, to the point that I know Bo's not here today, but that I told Bo that we were going to renegotiate his salary if there was any more downturn, because I wasn't going to fire him. I loved Bo. He was so good at his job and he was so good at helping me, but I was like, I can't afford to keep paying you at these rates. And that's that. So we were cutting to the bone at that point. And so I immediately looked at all my service providers, including my utilities, my telephone. I mean, see if there's some way that you can add, that might pick up $100 a month right now. I know this sounds ridiculous, but if you start piling up, there's $100 there in your utilities. If you go price your car insurance, your homeowner's insurance, and you pick up, there's another $600 that you pick up there. You're like, there's $700. You go look at all your streaming services and figure out, hey, can I just dial it down to maybe one or two? Or maybe we just use YouTube, the actual free streaming side of it for a few months for entertainment, because there's lots of stuff out there on that. I mean, you might find all of a sudden you just found $800 to $1,000 a month. Guys, that's big. I mean, and the other thing I always tell people, this cash reserves that you built up, make sure it's actually doing something for you. If it's sitting at a traditional brick and mortar and it's making less than 0.5%, go get that somewhere where it's making, that 3.5% to 4.5%, because I'm always amazed when I talk, especially like to my retirees with their cash management. I'm like, you realize that's almost 1 month of living expenses. If you add up what that cash could be generating for you, that might be the bridge that gets you one more month. If you can stack up these little decisions, you will probably be in a good place to weather the storm. I would encourage you, I still, try not to take your investments down below 15% of your gross income if you can avoid it. Obviously, it can go below that if you haven't filled up your cash reserves to what they need to. But I don't want you getting into a point where you're walking away from all the wealth building habits too, because it can be scary. But do a true risk assessment of your life. Put on your 3D glasses, like I shared on a previous answer, and the fact that you can have your dream, you can have the down to earth plan, and then you got to have your do plan of, man, things are bad. Just make sure you're taking all those into account so that you're prepared to handle whatever comes your way.
Yeah, really good. Best of luck to you, Wanda. Thank you for your question and for joining us in the live stream, and hopefully that helps you out as you just think through what might be happening down the road. All right. Next up, we've got a question from eMoney. You talk about, you're laughing. I knew you would laugh at that. Okay. You talk about 20 to 25% being aspirational in your 20s sometimes, right? And 20 to 25% savings rate is what they're referring to.
Yep.
But then the messy middle happens, and the 30s seem like it would be even harder to get to this, he says. Yeah. Are most people able to increase their savings rate throughout their 30s? What do you think?
Well, this is where, we talk about, everybody talks about the latte effect as one of those things sitting out there, Reby, with the coffees. And look, I want you to be disciplined with the way you spend every dollar that comes in your possession. But the messy middles is where the Lambo effect, or you think about the housing, the cars, those type of big decisions have a huge impact on the messy middle. Because, especially there's a movement to only do 15-year mortgages, only do, you have to put down 20% and all this stuff. And you're like, wow, how in the heck do you do it? That's why we've tried to have grace in our guidance, and the fact that first home that you're buying in your early 30s, it's okay if you only put down 3 to 5%. That's what, I walked around and talked to all of our financial advisors here, and I said, tell me what you did. And I asked myself what I did. And we eat our own cooking here. I want to be very transparent, because I would be a hypocrite if we did something different. Take advantage of some of those flexibility things. I think it's okay to only put down 3 to 5% on that first house. I think it's okay to do a 30-year mortgage. You can still pay it off in 10 years if you want to, or 15 years. There's nothing that says you just go pay a little bit higher of an interest rate. And with interest rates being as high as they are, I understand that's a pressure, but also think about it from a cash flow perspective as well.
I really like that you say keep your housing at 25% of your gross income.
Yeah.
That kind of changed my perspective. And then it was like, oh, and you can put 4% down and still get real estate in the messy middle. Because he's right. It does get kind of tricky as things start to pull on your pockets, if you will.
There is so many things that are becoming, pulling against you. That's why, earlier we had a question on when did I finally feel comfortable financially. It wasn't until my 40s. And I think that's probably, I kind of hesitate to say that so easily, because people will be like, well, heck, if I can't feel comfortable until I cross the 40 mark, I'll be an old person at that point. No, you realize from 20 to 40s, yes, that is a fun period of time, but it's also such a crucial time from building the foundation of your financial assets. If you take that 20-year period and compare it to your life expectancy, guys, we're really asking for you to be just prioritize being good with money for about 20% of your life. If you could really be disciplined, live on less than you make, think very deliberately about every decision you make, especially the big ones on the cars, the houses, but even lifestyle. I think you'll see that you can do this. I mean, look, I've realized E-money. A lot of people think I'm a little tone deaf, but I walk the walk. I mean, I know what it's like to come out with no money from college. I also know what it's like to have a great paying job in my 20s, but because my dad passed away, I went and started my first, venture by myself. I went out on my own, and I went from six figures to $17,000 a year. I know what it's like to go from plenty. It could go from broke to pretty good to broke, and then build something pretty spectacular in the background. And that's the part I just want to make sure I share that wisdom with you. And I just know how powerful the 20s and 30s are. And I know I'm asking a lot. It's no different than a personal trainer who, you're sitting there cussing. You're like, I'm tired of sweating. I don't want to do this. All I want to do is go sit down and watch TV or relax or start scrolling on my phone. And that trainer's going to be like, no, we're going to get back to it. We're going to do a circuit this time where, you no break. Let's see how far that heart can go. That's exactly what I'm trying to do with you, E-money, is I'm trying to stretch you while the money is so valuable from an exponential compounding side that you don't miss it. Because even with our wealthy clients, when we do our annual survey of impact from them, when we give them the open section and say, hey, what's something you wish you could tell your younger self? They always say, I wish I'd have saved more. These are successful people, but it just shows that this is something a lot of people have this regret. And I just want to make sure I'm giving you the right guidance so you do it right and you're very purposeful with every dollar that comes in your possession.
Yeah, that's really good. And I'm in the messy middle. I do think it's difficult to get to that saving percentage sometimes, but I like having the goal. And I like hearing the motivation because you're totally right that now is the time to do it because I'm only going to be 30 once and then my wealth multiplier is going to go down. And
it doesn't have to be all or nothing. I think that next time you get a pay raise, if you get a 6% pay raise, why can't you prioritize 3 or 4% of that to go towards advancing your savings and investment? It doesn't have to be if you're at 5 or 6% because that's what your employer told you had to do, but you want to be at 20%. There's nothing that says that next year when you get a pay raise, you can't take that to 10%. Yep. And then, but next year you get a bigger pay raise. Maybe now you've taken it to 15%. You're right. When you're 20s, it's aspirational, but in the 30s, it's something that definitely should be a priority. And it's because if you saw the drop in compounding, meaning what is the opportunity for every dollar, what they can become, it will motivate you. Go to moneyguy.com/resources and look at our money multiplier. There's a reason we talk about $1 for a 20-year-old has the potential to become $88 by 65. That same dollar, by the time you reach 30, it's $23. I mean, think that was almost a fourfold reduction in what that money could become because the time, that 10 years between 20 and 30 was very valuable. But 23 is still an incredible versus 7 at 40. So in that, once again, another third divided by 3 almost on how much we reduced just because we took away that component of time. So that's why we prioritize your 20s and 30s. You won't feel like you're building wealth, but that's your get rich money right there. It's just it won't feel like that because you got to let it grow under the surface, reach that boiling point. That water doesn't look like it's doing anything until it reaches that 100 degrees Celsius or 212 degrees Fahrenheit. But I'm telling you, there's a lot of stuff going on under the surface. So do all the actions you have to in your 20s and 30s so it actually works for you.
Yeah, Brian's been there. I'm there now. And I've just been struck more and more with how it is possible and how I really do think people get caught up in lifestyle creep because I see myself like inch there, like how much is the bigger house? And I'm like, why would I do that? Then I'm going to like undo all of the progress that I've made because I'm going to have to like allocate a bunch more money to a house, and it's silly. It's a little bit silly because
well, there's a lot of smart people that are trying to create products that you only have to spend $100 and $200 more to have that luxurious lifestyle that you think everybody really wants to see you have.
Yeah. So good thoughts. Thanks for the question, E-money. All right. Question from Brandon. He says, this is an interesting one. I'm excited to see what you're going to say about this. He says, can we introduce some nuance for financial mutants? If we have a higher income in our 20s and invest over 30%, would Brian still say avoid a luxury car even if we can pay it in 1 year, same as cash?
This is back to the financial order of operations. I mean, I would go, download the free resource, download or go buy the course.
Moneyguy.com/resources.
Because I'm actually the opposite of this. One of my
Mhm.
favorite things about what I get to do for a living. I think a lot of people assume that a financial advisor is all about the no. Because you listen to too many Susie Orman episodes or something where she's like, no, you can't go on vacation. You can't do this. You can't do that. I actually love in my job more often than not. I'm telling people, yeah, go spend your money. Go do something with it. I tell people, here's all I would say on this is for somebody who's in their 20s who has a great income coming in, you better know when you actually want to retire. If you're more of a traditionalist and you think you're going to retire 60, 65, by the way, we have a great resource on this. Go to learn.moneyguy.com. We have the Know Your Number course. If somebody has a traditional date of retirement, there's a reason I have the 25% of your gross income to free you up, is because, somebody who has a traditional retirement date of 60 to 65, you can easily accomplish that if you're in a high income situation in your 20s by doing, if you reach 25%. I'm not going to pick on you if you go buy a nice car, especially if you can pay it off within a year to do that. I don't know if I would do it that way because I know how powerful those dollars are, but I give you permission to consider that. What I don't want to have happen, though, is you or somebody who's in your 20s and you're under this impression that you're going to retire when you're 48 years old. If you think you're going to retire at 48 or 50 years of age, you got to be saving more than 25%.
The car might not make sense.
Even 30% might not be enough, like you said you're currently doing. And then, but for sure, the car is not going to make sense on that, because that's why we did the illustration. It was on a recent episode where we said, hey, let's take a car that's getting a lot of press right now, which is the new Corvette. It looks like they pulled up an old Ferrari, and then they said, hey, how can we make the Corvette look like a Ferrari? And then got everybody all hyped up and excited about it. And I think a lot of people are shocked when they find out that the typical purchase age for a Corvette is it 61, 63? It's somewhere in that early 60s age. It's not the 25-year-old that the best version of ourselves we envision when we're 16 years old and think we're going to get out of that. I had that vision. I told y'all that. And then I got to 25 and I was like, no way, no how. I know how valuable this money is. I got other priorities in life. But it is one of those things, because some people are car people. I mean, I've had friends that are car people, have to have the latest and greatest car. Just know your why. Know what the value is for you personally, and make sure you're reflecting and respecting not only where you're going, where you are, but you have your why and your priorities tied in together. Because I think a lot of people are focusing on the present bias, because that's a human nature thing, is that we focus on now versus the future. Deferred gratification is hard, but as long as you paid respect to the deferred gratification in the future, and you know what your why is. If you got a little bit extra, because look, you don't get to take it with you. I recognize that. You don't get to throw it all in the casket with you. So I want you to live your best life. I just want you to know how valuable every one of those dollars you have in your 20s and what it can become.
Brandon's original question was, can we introduce some nuance for financial mutants? I think you do give nuance.
Oh yeah,
especially
it's already there.
Sometimes when we're in financial content creation, so we see what other people are saying, and there's some good advice, but I think you give more nuance. You're very solid on what you believe, but you actually do realize that there's some difference, and it all comes back to what your why is and what you've actually got going on. How much are you saving? Are you really serious about that? So I like that answer.
We're in one of those no-win situations, because if you see, some people will say, they always say the same thing. And then other people will be like, man, I wish that, I feel like you go way out on all these things. We can't win on those things, but I want you to know, I feel like I'm pretty consistent on this. I try to, as I've always shared, we show you the numbers. I practice what I preach. I eat my own cooking. And that's where all this comes from. I mean, that's why I love sharing the experience, because the why lines up. Is why do I come up with these thoughts? Because I know what it's like for your father to be laid off when he's in his 40s and you're a kid. I know what it's like to be in your 20s and you got a growing family, and then have the real estate market collapse and that, and not having cash reserves. I try to give you the full spectrum of all the things you ought to think about financially.
I love it. Thanks for that question, Brandon. Moving on to Beely's question. In a previous video, you mentioned keeping liquidity to seize opportunity, inspired by Uncle Warren. But liquid cash is depreciating. How much beyond 6 months would you recommend?
This is a true statement. I've talked about this because I do think cash can be a huge wealth builder if you are the only person in the room that has it when everybody else is underwater. Because everybody takes it for granted. Nobody thinks, it's back to Uncle Warren. You can always tell. I'm going to paraphrase because I have my own, folksy way of sharing things. You can tell who's skinny dipping when the tide goes out. And that's what you can see who's naked. Because Uncle Warren, I think he said that in 2003. I'm trying to think of when that quote, the letter to shareholders, but it was, it is so true. I've lived long enough that I see people, they want to live for the now, and then they never build up that liquidity, and then it goes away. But what she's actually asking about is, what about building wealth with liquidity? First of all, this is advanced level planning. This should not even come into play until you're kind of in this level 8 of the financial order of operations. Letting everybody, if you go to moneyguy.com/resources, you can download the free deliverable. If you want to deep dive on accelerating your wealth, you can go to learn.moneyguy, and we actually have a course on it. But this is definitely step 8. Don't even consider doing this extra cash until you're really beyond step 7, which is hyperaccumulation, meaning that I want you to have on autopilot, you're saving and investing 25% of your gross income. And now that you've already put that to aside, you've got that on an automated, inevitable wealth journey, but you have extra cash that's building up, and you're like, well, what do I do? Here's what I've done. As I know, like we bought during the pandemic, people panicked about office space. So Bo and I were able to buy this beautiful building that we're in. And will probably be our building for at least the next 10 years. And then I think even if we outgrow this building, which will be a blessing if we do, I'll still keep this building because it's on the square of downtown Franklin. This is the Fifth Avenue of Tennessee, right? I'm telling you, this is a gem that we landed. Would not have been able to do that if I didn't run thick on cash. Now I realize I own some small businesses. I have employees. So I know a lot of people are counting on me to have extra cash more than others. So I carry that responsibility. And Warren is kind of, with Berkshire Hathaway, they have extra float because they're an insurance company. So it kind of requires them to run extra fat on cash. But she is right in the fact that cash does depreciate, meaning that even though cash right now is paying over 4.5%, if inflation is at 8%, your purchasing power is being taken away. But I always know there's a cycle, that there's going to be a recession typically twice every decade. So that's not so much time that has to go by that you can take advantage of it. Because right now, like real estate, you don't make your money long-term on the real estate traditionally right out of the gate on the cash flow. You make it on when you purchase. And valuations got really rich during this post-pandemic when all this money came out. Real estate values spiked up, inflation spiked up. I wouldn't be hot and heavy to be running out and buying something right now, but I would be getting, because like I said, all the extroverts of the doom category are all hanging out together. You're starting to see unemployment spike up. You're seeing real estate's not selling as fast as it is. We've got market volatility where the market was down over 20% last year at points in the year. All those things are hanging out together. That always makes me think, hey, there's going to be an opportunity potentially that you could use this. And here's the thing, it can change from year to year. Maybe you realize that you ran a little fat because you're worried about your job, or you're worried about the uncertainty of the economy, and that created an opportunity that you could buy a building, or you could make a bigger investment because an individual stock that you think is going to be around and great for years went down to super cheap bargain basement prices. But you'd have money to jump into it. But maybe you come out of it and happy days are here again and things are rocking and rolling. You always have the option of redeploying that cash, and then you can increase your dollar cost averaging. That's the other thing I like, is when I feel like my cash is getting too big, I will just say, you know what? Great time to increase that monthly investment again. So I'll add an extra few $1,000 in each of the months. And then it's kind of another forced scarcity game I play with myself. It's like, I wonder if I can do this for a full year. And then after you do it that year, and if your cash is still at a good place, but hey, why don't I kick it up again and see if I can do that? It's kind of like a lot of people who don't like running, but run because of the benefits of it, will use mailboxes as inspiration. Hey, can you run to that mailbox? Can I run to that stop sign up there? And you're giving yourself things to push you. You can do the same thing with your cash. Build it up. After you've made it to step 7 of the financial order of operations, you can always go back and redeploy it later. This is one of those things where there's already going to be comments say he didn't answer the question. The reason is because there's too many nuances on this that I can't give you, but I can tell you parts of the facets of what you should consider so that you can hopefully make the best decision for your personal situation.
I think that makes a lot of sense. Beely, thanks so much for sending in that question, and we appreciate you being here. You're not going to believe this, but Bizarro Brian is back.
Oh, Brian J.
He was Brian J. Now
well, he is Brian J.
Now
it's
he's
just
Bizarro
I'm
Brian.
Jay Brian. He's Brian J. That's why he's Bizarro Brian, because he's me, but the opposite version of me. So this ought to be interesting.
Well, he had a question for you
Okay.
that I kind of liked, so we're going to ask it.
Man, is this 3 for 3? Has
know,
he been
I
on the
am
last 3
realizing
episodes?
I'm getting a
I
little
promise
lazy.
there's more than 4 people that watch our live streams, by the way. So Bizarro
for sure.
Brian, that's good on you.
I
Keep
know.
going.
Well, here's his question. He says, when Brian says take your foot off the accelerator in your 40s after saving in your 20s and 30s, is that altering the FOO? Could that mean the savings percentage drops below 25% in your 40s?
Oh, that's a great question. He's trying
Isn't
to
that
catch me.
interesting? I know he is trying to catch you. I think I know what you're going to say, but I'm interested.
Okay, full confession. I told my wife in my 20s that we could take our foot off the accelerator. That's all true because I eat my own cooking. I try to be as transparent. But here's the reality, and this sounds like such... These are wealthy people problems, is that the business has grown. It seems like the more I give you guys, the more you guys give back. And it's kind of the most blessed thing in the world. It really is. So the truth is, Bizarro Brian, I didn't have to take my foot off the accelerator because income went to the point that I could still live my best life. And then there was money. But here's the good news. I could. If you go check out our Know Your Number course, you don't have to save. And now I'm in this point of abundance with life that I'm trying to... I'm doing stuff because it's just fun and I want to see if it works. I mean, that's what, you look at all the things we're doing with the content, buying the equipment. We didn't have to buy all new equipment when we moved to the new location, but we did because I wanted to see, hey, would this work? Us redoing the website, all this. I'm now in this level of abundance where that I can do stuff for the purpose of it, the fun of it. And what's crazy is I think it will probably generate more income. It's this weird thing, but that gets me excited too because I love how fast we grow. I mean, we're now, I think in the next 2 months we'll be at 30 employees. And it seems like a few short years ago we were like 5 or 6 employees. So I mean, nothing gets me more excited. If we added up how many babies are going to be born within this, within our employees this year. And then you think about, cars and houses being bought. I mean, I get so excited thinking about those type of things and the opportunity. So I don't know if that helps, Bizarro Brian, because but yes, you could take your foot off the accelerator once you do something like Know Your Number, where you measure twice, where you actually know what you're saving for, what the why is. But I put that out there just like a personal trainer would, thinking that if I make you the best version of yourself, there's a chance, because there is this achiever dilemma that you get into, especially in your 40s, is that you're going to be making some of the best money of your life. And you have to figure out what's enough. And when do I get off the train, or do I do life? But I'm in this weird pickle that everybody I know who is part of the FIRE movement and retires early, what do they do after they retire? They all become content creators. Have you noticed that? I mean, it seems like they didn't really retire. They all just become content creators.
Of them do, yeah.
So I'm already doing that. I was partying before everybody else realized where the party was, because I started doing this in 2006. So I'm blessed in the fact that I get to take all the fruits of what I created to kind of do what others are kind of going to. It's like that scene from Yellowstone where, and I don't know character names, so I always like Kevin Costner's character. He tells his attorney son, who turns out to be the villain. I'm not trying to do spoiler alerts, but anyway, at the time, I think this was an early season, he's like, son, you get rich to own this. So never sell this, because this is what you get rich to own. And, you know, and it's one of those things where I feel blessed that I get to do this, and I get to do all the things that are impacting your lives, making you guys better. That I didn't have to actually take the foot off the accelerator, because you guys keep rewarding the what we're doing.
Isn't that the point though? Like when we talk about the 5 levels of wealth, when you talk about financial security and financial independence, it's that you get to do what you want to do.
Yeah. Yeah.
And like your money is working hard enough that you can. So I think that like, I think it's a lot, to me, correct me if I'm wrong, it's a lot less about like, oh, well, I'm 40 now, I can take my foot off the gas. It's more about like, well, what's your goal? What's your money doing?
Yeah.
How much do you have saved? Like, I think it's more about that. And like you said, you have potential if you're putting things in place. The 40s could be a really abundant year for you income wise. And so you might find yourself in that situation, which you're speaking to. And then you're faced with the kind of fun questions of like, how much is enough? What do I want to do? I have some flexibility. What am I going to do with this income? I think that's pretty cool.
Well, it's much better, because it's one of those things, you can take your foot off the accelerator. Will you do it? But I got to tell you, that's such a better, healthier place to be than having to do something because you got to pay the bills. And that's the thing. That's why my guidance doesn't change even living through this, is because I want you to be able to choose your best life. And if the only way you can do that is to make those sacrifices in your 20s and 30s, bedazzle your basic life, still go out there and create memories. I'm not saying be Ebenezer Scrooge, but just save every dollar like it has a purpose, so that you can actually have those choices, have that freedom to do what you want to on your own terms.
I love it. Well, thank you, Bizarro Brian, for that question and for joining us in the chat.
We'll talk next week, Brian J.
I know, maybe we'll talk to you again next week. Keep submitting the questions. And thank you to everybody for submitting the questions. I have something for you. It's free. Go to moneyguy.com/resources right now, because if you liked Brian's answers, if you liked these conversations, if you have more questions, there's a chance that we have answered it in a free download on the website. We've got everything up there from your wealth multiplier, like how much is your dollar going to turn into by the time you retire? How to refinance your house, some of the nitty gritty stuff like that. We've got some tax information up there. I know it's the new year, so we're starting to think about that. So yeah, go check that out, moneyguy.com/resources. And as always, if you want to be part of the community, if you want a deeper dive, if you want to consolidate the information today into a bit more of an even more digestible way, check out our courses, learn.moneyguy.com. We've got the Know Your Number course about how much you need to retire. We've got the Financial Order of Operations course showing you exactly what to do with your next dollar. Do yourself a favor, go check that out if that at all piques your interest. We did all that for you because we love doing this every single week, answering your questions, bringing the financial knowledge, all that stuff.
I got one other ask. We never ask people, just subscribe. You know what? Sometimes I never ask. We need to put a little reminder across there because we're horrible at that.
Tell people to subscribe.
Tell people to subscribe. Check out, subscribe, turn on the bell. You know, I don't have a fancy way like smash it, crush it, invest it, whatever it is. But I'm your host, Brian Preston. Mr. Reeby. Mrs. Reeby. I got to make sure I get all the entrances. The rest of the content team, Money Guy team, out.